Your heart sinks as you realize it's the bank on the other line. You've been expecting this call. Yes, hello, it's John from your bank, and I have some bad news. We've recently completed a valuation on your home, and it's worth less than the mortgage you owe us. As a result, we'll be looking to repossess your property. Today, we're talking about negative equity. This happens and occurs when your property is worth less than the mortgage you owe the bank. We're looking at what your obligation is, and more importantly, how you can stay out of harm's way if this does happen to you. So stay tuned. So let's look at what equity is, and more importantly, what negative equity is. So equity is essentially the value of your home versus the value of your home. So in this case, we've got a $300,000 loan and a property worth $500,000. So if we brought that up to 80%, it'd mean that you'd have $100,000 in equity available. That's essentially a $400,000 loan minus the $300,000 you already owe. Negative equity is essentially this in reverse. So if you have a property worth $500,000 and you have a debt of $600,000, you're in negative equity territory. And this can be a big problem. By the end of this video, I'm going to show you exactly how to stay out of harm's way, so keep watching. Now, as a mortgage holder, you've entered into a contract with the bank and you've signed their consumer credit contract. This is essentially all the terms and conditions you've agreed to. So let's take a look at that contract and let's take a look at what the terms and conditions you've agreed to. So this is a standard consumer credit contract, and essentially it'll talk about the total loan amount you're going for, the interest rate at the time that is applicable. Now, if it's variable, it'll go up and down. If it's fixed, it'll be locked in for that fixed period. It'll also go through all the fees and charges that may be applicable throughout the duration of the 30-year term. So this is an important part where we see part E. It essentially confirms what you're contractually obliged to pay back. In this case, we can see it's a 30-year term and there's in total 360 payments split up into 359 initial payments and one final one at the end of the 30-year term. It'll continue to go on to explain if you're on a variable rate, what can happen if you switch over to a fixed rate, and it'll also explain the security or property that the bank is taking over. So that's a consumer credit contract, and one of the things you'll probably have noticed is it makes no mention of what happens if your property goes into negative equity. It's because the consumer credit contract, the biggest and most important thing to the bank is that you're going to be paying your mortgage on time, every time. And this is something to keep in the back of your mind as we explore the next terms and conditions you've agreed to as a mortgage holder, because ultimately this is the most important part. If you're paying your mortgage on time, almost everything else will take care of itself. Now let's jump into the mortgage memorandum and look at some of the terms and conditions you've agreed to in them. And remember, each bank's going to have their own flavor, but by and large, these are the general principles that the bank is looking at. So the first item that's worth highlighting in the mortgage memorandum, and I quote, "When we release the property from this mortgage, your obligation to continue to pay the amount owing except to the extent we have told you otherwise in writing." And bringing this down to layman's terms, essentially it says that so long as you pay back the debt owing, that then there's not going to be any issues. So if you sell your property and there's still debt owing, that debt is still owed by you to the bank unless the bank had written to you otherwise. The next condition is looking after your property. So there's a condition in the mortgage memorandum that you can't be doing anything that will reduce the value of your home. And an example is making sure that your property is always well maintained. So whether that be garden or whether that be painting your property, and essentially in a condition whereby it's not going to reduce any appeal. So if you were to rent it out on the market, that you're not going to have a significantly reduced rental price. And the final one and the final obligation is to continue to have adequate insurance on the property. This is to cover everything from fire to accidental damage. The bank mandates that you have adequate insurance, so if the property does fall over or is burned down, that it'll be rebuilt from the insurance that you have in place. Now, taking all of this and bringing it back to negative equity. And I've talked to many, particularly in those mining towns where there's been booms and busts, and one person in particular owed a $400,000 mortgage and their property was only worth $300,000 at the time. This was back in 2017. And what they told me was that the bank didn't come knocking on their door. It's because they pay their mortgage on time every time. They maintained their home so that there was no issues with the maintenance and ongoing repair of the property, and that they had adequate insurance. And in this case, the bank never came knocking. It took a little while until the property became positive, and eventually it did get there. It shows that if you follow the guidelines given by the bank in their mortgage memorandum and their consumer credit contract, that providing you meet what their expectations are, that there's no cause for concern for the bank to be knocking on your door and asking for repossession of your home. And the final thing to keep in mind is all your subsidiary accounts. So if you've got credit cards or car loans or anything else with the bank, ensure that your conduct's crystal clean. So that's paying everything on time, not having any overdrawings. And by following these little tips, it'll ensure if you are in negative equity that for the short period of time that you'll be able to ride this wave and look to build towards a future where your equity will eventually get positive. Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a great mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065. We service Australia-wide and don't charge a fee. So hit us up. We'd love to help. And until next time, I'll catch you then.